Good day and welcome to the impact of COVID-19 on consumer finance. A small blip or a long pause conference call. Today's conference is being recorded. At this time, I would like to turn the conference over to Mohammed Irfan. Please go ahead, sir.
Thank you, Anita. Hello, everyone. On behalf of Everything, my colleague Vamshi and I, Mohammed Irfan, welcome you all to another session of Everything Capital's Impact 360 webinar series. The objective of this series is to bring to you an in-depth and comprehensive analysis of impact of COVID-19 on different asset classes. Sector in focus today is consumer finance. Rising income levels, soaring aspirations, positive economic tailwinds, and innovative digital lending approach were the pillars that supported the growth of consumer finance space in India, which saw participation not just from banks and NBFCs, but in many ways completely transformed the emergence of new age fintech lenders. The going was good, and the expectations from this sector were big, but the narrative has changed now. With the lockdown, economic slowdown, and uncertainty, loss of income, reduction in discretionary spending, are consumer finance companies looking at a downward trajectory, or will it be seeing a sharp bounce back? Is it a sharp blip? Is it a short blip or a long pause? That's what we will discuss today. We are delighted to have with us three industry captains, leading fintech and entrepreneurs, who will share with us the view from the ground and preparedness of the sector to deal with this situation. Let me introduce to these gentlemen. We have with us Ashish Goel. Ashish Goel is co-founder, CFO, Early Salary. He was CIO at Bajaj Alliance before founding Early Salary. I am excited to hear Ashish's view on fintech ecosystem, how he has approached and plans to approach the current situation, especially in terms of customer engagement and product. His views on unit costs and P&L, and now as well as in the short to medium term. Welcome, Ashish. I have with me Satyam Kumar, who is a CEO and co-founder at LoanTap. For around two decades, Satyam led traditional products including mortgages at large banks before founding LoanTap. We are looking forward to his deep insights on the customers that are targeted in the traditional fintech model. Welcome, Satyam. I have with me Madhusudan Ekambram, CEO CrazyBee. Before starting CrazyBee, Madhu led product management team at Huawei. He led these teams to build operations across countries from scratch. We are looking forward to discussing the current challenges and his views on how to manage these well innovatively and also come out stronger. Welcome, gentlemen. It's a pleasure having you all here. We'll begin the short presentation led by our risk head, Ms. Vamshi Vasudevan, and then follow it up with a discussion with the panel and finally open it up for audience questions. Over to you, Vamshi.
Thank you, Irfan. Next slide, please. So I would like to start the presentation with 3 data points. One is salary remittances. The salary remittances in major banks have not seen a dip until first week of April. This indicates that the payments for March remitted until first week of April were almost similar to pre-COVID levels. Number 2, percentage of customers opting for moratorium. In unsecured personal loan space, moratorium to borrowers was offered based on need. Request for moratorium has been received from only 15 to 20% of the borrowers across banks and NBFCs in the first window until 10th of April. Number 3 is collection efficiency witnessed so far. Collection efficiencies have been in the range of 60% to almost 80% plus across various lenders. The difference in collection efficiency could reflect the strength of the customer profile. The numbers, however, are much higher than collection efficiency noticed in other retail lending segments. These data points collectively, though are early indicators, lead us to believe that the intent to pay has not been disrupted for the segment yet. Next slide, please. Moving on to next slide. While the early trends are favorable, macroeconomic picture seems to be indicating a recessionary trend across the globe. Retail productivity matrices and manufacturing indices indicate a sharp decline. Unemployment trends have risen in the country with more loss of urban jobs than rural. Timing of April meant that variable pay has been withheld across organizations and pay cuts are a visible trend. urban locations and services sector are more impacted than rural segment until now. A combination of urban and services profile under stress seems to have a high correlation to consumer finance portfolio, indicating higher stress expectations. In the subsequent slides, we have assessed the real impact by breaking these two segments into the following. 1. Customer segments for NBFCs and their key risk factors. 2. COVID hotspots and their correlation to consumer finance portfolio. 3 is COVID impacted sectors from a business perspective and their correlation with consumer finance. The consumer finance is linked to India's consumption story, and the pie is expanding quarter on quarter with NBFCs gaining market share. Thanks to new age fintech companies, the outreach has expanded significantly. What is important to note here is so far, NBFC delinquency rates are about 100 basis points more than private banks across PAR buckets and slightly lower than PSU portfolio. This drives us to the question on who is the customer for an NBFC. Now, strategy for NBFC have been to catch customers early. One of the key differences between NBFC customer profile and bank customer profile, and even within NBFC portfolio, is the age of the customer. Some of the new age fintech players could have an average customer age of around 25 years, while banks would always prefer customers in mid or late 30s. NBFCs have built-in mitigants by varying ticket sizes and tenure to cater to this profile. However, the key risk of the segment is higher indebtedness due to consumption behavior, which may play out at times of stress. So the next section is on how urban is consumer finance portfolio. Consumer finance portfolio has been primarily urban-centric with concentration in southern and western parts of the country. Tamil Nadu, Kerala, Telangana, Maharashtra and UP contribute almost 40% of the portfolio. Breaking it down further, most of this is derived from metro cities of Bombay, Pune, Delhi, Bangalore, Chennai and Hyderabad. Slide number 8 indicates that both private banks and NBFCs have been incrementally sourcing from in the kind of customers sourced. Slide number 9 maps the COVID heat map on the left and consumer finance distribution map on the right. Clearly, the overlap is significant. Consumer finance companies are concentrated in metros by virtue of their business model, which are the COVID hotspots. Now, impact to the segment is clearly visible. Extent of impact is dependent on the underlying business models, which is what we've mapped in the next slide, slide 11. We have listed down key segments impacted by COVID and extent of job loss in each of these segments. Also, the nature of job loss, i.e. permanent versus temporary, will determine the extent of rollback that can be expected in the portfolio. Travel, retail, wholesale trade, retail trade, leisure and entertainment, restaurants, aviation, and informal segments across sectors are highly impacted. NBFCs may have some portfolio in each of these segments, but majority, almost 60% of the portfolio, comes from IT and allied services, especially for the new age fintech players. These sectors have remained stable so far. Long-term growth prospects and job opportunities may be curtailed based on global trends, however. Job loss is not a feature of this segment currently. At a portfolio level, higher collection efficiency in personal loan space compared to retail loans is possibly due to higher concentration of IT and retail segments. Aviation, leisure, entertainment, travel and self-employed economy may take longer time to recover. Moving on to the next section, which are performance indicators. The map on the left indicates part 30 of the book. Part 30 of the book as of March 19. The part 30 was in the range of 3 to 4% across geographies, with some locations showing higher parts. Asset quality, which is asset quality as of December, was showing signs of stress. The signs of stress were visible even prior to COVID in some of these geographies. Now, average bounce rate for this segment is about 15%. Post-COVID, in slide number 14, we can see the bounce rates have doubled. Ranges vary from 26 to 35% across lenders. India map to the left, and then we put up a retail portfolio performance from March 21st to April 26th to the India map on the left is the retail portfolio performance from March 21st to April 6th, and the map to the right is the COVID heat map. High penetration zone for consumer finance is still not in red from a collection efficiency perspective. Hotspots in COVID, which we explained, Tamil Nadu, Maharashtra, and the southern and western parts are still seeing collection efficiency almost 50 to 70% across geographies. Moving on to the next slide, which are lead indicators of performance, which is the inquiry information that Credit Bureau has seen. Chart on the top left indicates that demand for personal loans has dropped compared to March 15 levels. However, the drop in demand is much lower in this space compared to other retail loans. Chart on the top right indicates the performance towards and preference towards NBFCs for personal loans during times of stress. This could be due to higher tech and tech-driven processes that Fintech NBFCs and NBFCs in general deploy. Chart in the bottom right indicates demand for consumer durables has dropped drastically. This could be attributed to shutdown of stores on account of lockdown. Trends post-lift of lockdown would indicate customer spending behavior. Moving on to the next slide, which is on path to recovery. GDP estimates indicate that 30% comes from discretionary spend. Initial signs of lockdown has shown the following trends across the globe. Early behavior of spending more to stock up essentials. Number two, the second phase is to cut down on discretionary spend due to uncertainty. Now, cutting down on discretionary spend has two positive effects on consumer finance. One, from an asset quality perspective, decrease in spend may result in increased savings, leading to lower indebtedness and improvement in portfolio quality over time. If income levels sustain over 2 quarters, the nature of rebound could be shorter with regards to asset quality. Growth. McKinsey report on consumer sentiment indicates that 50% of the consumers expect lockdown to continue for more than 4 months. These kind of sentiments could result in changes in spending patterns, loss in brand loyalty, lower ticket size purchases, and more dependence on digital economy may be witnessed. Spending towards health and safety may be witnessed. Personal loan disbursements may shift to funding expenditures incurred towards health and well-being. Moving on to next slide. From a liquidity risk perspective, NBFCs with shorter tenor books have not availed moratorium due to highly liquid asset profile. NBFCs with longer tenor portfolio who had availed moratorium have received approvals from most of its lenders. Specifically for fintech players, sourcing and acquisition of customers was major expense. Also, majority of the cost was variable in nature. With disbursements to new customers on hold, most of the NBFCs have been able to cut down OPEX by almost 70%. This has again helped in strengthening the liquidity position of the companies. Companies with shorter asset book are not exposed to liquidity risk. The longer asset book liquidity would be a function of collection efficiency. So clearly, liquidity risk is not a challenge at this point to this segment. The key challenge in this space is to ensure that the NBFCs are in touch with the customers and to come up with innovative product solutions for those customers who have been impacted by COVID. The key challenge is to train the collection staff on do's and don'ts to ensure smooth communication, and of all, the most important challenge is to quickly adapt to the current scenario, modify underwriting practices and operations based on the need of the hour, and to reignite growth engine. Thank you. Over to you, Irfan. Hello.
Thanks, Vamsi, for setting up very well for our next session with our guests here. I welcome Ashish, Madhu, and Satyam again. Let me start with Satyam. Could you please throw some light on customer profiles in consumer finance? Understand what are the general purposes for which they want to borrow? And even during these times when there is demand and loan is available online, how do you think as a lender now and from collections point of view later?
Yeah, sure. Hi, good afternoon, everyone. This is Satyam. I represent LoanTap in this conversation. Thank you, Irfan, and thank you, Viviti Capital, for creating this platform to talk about the consumption segment in India. So just before we go down to the segment, I'll just take 2 minutes to give a sense of how we see COVID or Corona itself, the whole event. So in a classic Indian context, you can always compare with multi-headed snake. So it's not like a one particular event which you kill and you go ahead. So it's like a multi-headed snake, like a Vasuki, which will require a vaccine or a Krishna to come and kill it, or for us to get over it. So it's about a 12-month to 14-month job from now. So either from between December to April, we can hope to finally get rid of it, and so we see prolonged engagement across the large geography of India. So in some patches, this problem is more evident today. In other patches, it will be evident maybe a few weeks down the line, and so it will keep on raising its head from time to time, and that's a learning which we can see from the early economies which has gone through it, like a China or what we are seeing in Europe, many of the countries which is coming out of it, opening up. So we'll see a similar trend in India. A large geography makes it more challenging from a country point of view, but state to state point of view, it will keep on giving a different trend. That is how we see Corona or this COVID-19 as a whole. And that's how, as an organization or as an institution, the response mechanism has been delivered. As it is evident towards the last slide in terms of the nature of inquiries, I think one of the biggest mistake which we often make in this segment is we look at personal loans or the small ticket consumption loan from a point of view that it is for discretionary spends, it's for random spends, and that kind of situation. The answer probably is mostly away from it. 2/3 of all the loans which is being picked up, anything between 10,000 to 10 lakh rupees, and where the end use is not specified in the fashion that it has not been defined like a home loan or a car loan. Those, however, if you track the end use of all this money, which we always do at the time of underwriting, we see that most of the money goes for medical and home improvement. When it comes to medical, it is about, in India, we know that it's an underinsured country, so we have people who has, and we live in a large family, joint family, so there will be one member or another member, even if I'm covered, who is not covered, and the medical expenses are pretty large. So that's one clear category which consumes almost 1/4 of all the kind of small to large unsecured loans which is getting taken, which has been being picked up by the salaried segment in the country. I mean, non-business kind of unsecured loan, I mean to say. Second biggest category there is also in India, it has seen a mobility of in the urban middle class towards lifestyle. So lots of people have migrated from small cities or villages to the town, and they have been improving on their lifestyle post their marriages, husband wife working, moving into larger house, better house which needs to be furnished. So if you look at some of these platforms which sells furnitures and all, and you will understand that most of the expenses are being done in the living room. So there are the very clear trends which says that 1/3 of all this, 2/3 of all the money which is taken from institutions like us goes through the basics, which is medical and improving on the basic necessities of the life. Naturally, that trend is also reflecting that even if the demand for vehicles, the demand for home and all is down and out at the moment because people are grappling with the situation, you still see inquiry for a personal loan, or you still see inquiry for a medical loan or this kind of a product. So it's very much validated there. Naturally, and what we see is that only about 1/3 of all the loan which is done in this fashion goes towards discretionary spends like a travel, wedding, or other lifestyle like consumer durables or even consolidating the debt which is running from multiple institutions. So that's only about 1/3. So naturally, we see 2/3 of all the businesses which it was to bounce back very quickly, and that's limited more because of the people's inability to move around and not because of the demand or anything. So that's what we see in terms of the consumer demand side, and the remaining 1/3 which comes from a hotel, weddings, and that kind of a segment will take slightly longer time, will bounce back probably around September and all, when we see this Diwali and general animal spirit in the economy kicking in. So this is how we see the segment itself. If you see overall the fintech lenders, we still cater to a very small percentage of the economy. So when we look at the ecosystem now to both to fuel the consumption as well as to fuel the growth in the economy, even in the critical sectors, the kind of railroads that we have created will be required by ourselves as an NBFC. At the same time, it will be required by now all the banks or the financial institutions which are still not prepared technologically to do a delivery in a touchless manner. Okay. And that will also reflect from the fact that you have a large institutions which will be coming and claiming that our collection ratios are in range of 20-25%, but all the fintech lenders will show the collection efficiency in the range of 50-70%, because 90-95% of their payments comes through the NACH and IMPS network, which is a digitally active and very much doable even today. So I think the railroads which has been built by the fintech ecosystem is the one which will be shared with the banking and financial institutions for them to reach out with all these initiatives which we have with the government, as well as the forms will be taking to grow the business. That's
Sure.
kind of a sense on the customer side as well as the business side I wanted to give.
Sure. Thank you so much, Satyam. I think taking a cue here from what you left in terms of customer requirement for loan, etc. Can I take the lead to Madhu and ask Madhu? Madhu, what do you think about the customer engagement aspect here, and linking that to managing those who are demanding loans now? Even now there is a demand for that. How do you look at data, and also from an educating the system and ecosystem perspective, and also managing stress, and also your view on collection? And you may throw some light on the collection efficiency numbers that you are seeing. Welcome, Madhu.
Sure. Thanks. Good evening, everyone, and thank you, Irfan, and the Viviti team for kind of inviting me to kind of speak in this session. I guess you guys are doing a wonderful job by connecting all the industry stakeholders on one platform to share our common issues and common practices during this kind of a pandemic situation. So great. I think largely one thing is about like fintechs are kind of based on a lot of data. We deal with a lot of customers across all pin codes. So the pandemic effect as such has kind of affected almost all the industries in India, and I don't think it's no wonder that it has its adverse effects on the lending industry as well. And specifically speaking about the fintech industry, it has its own effects. Now, just talking about, since the question was about like what kind of underwriting or the data wise, how do I look at it? A lot of data points which kind of help us to underwrite a customer before the COVID-19. That's probably no more kind of maybe valid to kind of underwrite them post COVID-19. The data points on the salaries or income levels or cash flows, what we saw in the self-employed segment in Jan or Feb, may not make a lot of sense to kind of look at them in May or June, right? So there should be a refresh of all these data points in terms of how do we kind of underwrite the borrowers. It is very much applicable both for the salaried segment and self-employed segment as well. In salaried, what we are seeing is that a lot of people who are earning X rupees are kind of got a salary cut. A lot of people have had their own bonuses bucketed in their own budget. I think the bonuses are all long gone. So the income levels itself has kind of at the industry-wide, it has deteriorated, at least by 25-30% for the salaried customers. And within the self-employed segment, I think it is quite large in the sense that for all the shop owners, I think the shops are shut as long as they are not doing any kind of an essential services or so. And in terms of gig economy, depending on where they are involved in, so a lot of mobility services, be it the cab mobility or the bike mobility kind of guys, are kind of not in the industry anymore, probably during this particular lockdown session. So the variables what helped us to kind of assess these individuals prior to COVID or prior to the lockdown will have a very different effect once the lockdown opens up, right? So I think there is a lot of algorithms has to be refreshed in terms of trying to underwrite these guys newly. So that's one point. And the second point is, I think what is the other effect of this particular system is also that it has taken a good toll on a different kind of industry in a different way. For example, the consumer loan itself, as in like it has multiple kinds of products. There could be consumer durable loans. There are STPLs, what we call, which is a short-term personal loans. There are personal loans which are about a year to 3 year kind of a loans. So I think the consumer finance itself can be broken down into multiple products, and multiple products have a different kind of an issues dealing with this particular situation. Now, quickly jumping on to, so what's very important and how do we kind of do the collections at the industry-wide, or what do we see in this aspect? So first thing is, I think all this situation has led us to kind of, first thing is to educate the customer a lot. So as a part of collections or as a part of this moratorium what has been announced from the market, I think collection has become more of a complex equation of customer education around the moratorium and assessing the customer's ability to either pay the EMI or partially pay the EMI, and keeping in touch with the customers on a continuous basis. So it has become as a equation of multiple parameters for the fintechs or any lending industry for that matter. I think they have to consider a lot of these parameters to kind of ensure the collections are in a good balance or a hygienic balance to keep the company's liquidity in a healthy way. So talking about, I think, customer education, I think the fintechs had an upper hand because from the beginning, I think we were all kind of an app-based lending companies, communicating to almost like, a few lakhs of or few tens of lakhs of our customers. The digital ways come very handy. From the beginning, I think we had all these digital channels like, be it the auto calls or auto SMSs or the email being shot out to all these customers. So one of the biggest thing what we had to do was make them understand what exactly is moratorium, and the moratorium does not come without a cost. So just by pushing off your EMIs by 1 or 2 months, I think there is a cost involved in such moratorium options. So that particular education was very important because people were doing a lot of speculative work in trying to understand the entire moratorium in a very different ways. So the education came very handy for us, where we used even our app as an imperative to kind of communicate through push notifications or within the app communications to the customers. Now, the second thing is, unlike a standard institution or a bank, which gave an option in terms of either you kind of pay the EMI or you choose the moratorium and postpone your EMI 2 months, I think more than that, the fintechs could do a lot of work because of the technology as a backend and the agility with which we could act upon. We provided multiple options to the customers. One is something like, to just quote a few. One is like partially pay the EMI and then postpone the rest of the EMI to your next few months, or is something to coming out like a split your EMIs into 2 months or 3 months kind of an offer, or kind of waiving off a lot of penalties and then probably providing a cashback to ensure that these customers pay their EMI or even to go and close the loans, right? So these kind of multiple options were created on the app itself. So to provide a bouquet of options to the customers rather than just providing 2 options to choose from, right? So this on the one hand, it kind of helped the customer to choose based on his monetary position to kind of choose one of the options and pay back the EMIs or kind of choose the moratorium. On the other hand, for lenders, it helps us to kind of bucket these customers into various segments. There's a big difference between a guy who has taken a pure without any payment kind of a moratorium versus the guy who has partially paid and then taken a moratorium. So we could bucket these customers into multiple buckets, which will help us in future as well, while we have to target for the collections, right? So I think that is only possible because of the entire digital nature or the technical the framework on which the fintechs are built, right? So according to my understanding, I think what even Satyam was stating, right? So I think more or less within my own circles of all the fintech players, what I understand is they are all able to collect about 70 to 75% of all their EMIs. So only about like 25% of the people have chosen certain kind of a moratorium, and that kind of helps us define the risk very much at this stage itself. Compared to a specific industry where a cash collection or a physical collection is very is the backbone of entire collections. I think that there is almost like a 0% of the money has come back at this stage of the lockdown. Versus them, I think we are in a kind of a different situation wherein we can assess, what kind of risk can be anticipated 2 to 3 months down the line. The last part which I want to touch about, Irfan, I think is one is very important for all the fintechs or all the lenders is to be in constant touch and with constant communication with our customers. So just because there is even if you provide a moratorium, it doesn't mean that for next 1 month or 2 months we are not doing much with the customers, because the discipline itself might get affected in terms of their payment behaviors, or payment discipline will be affected if there is this kind of a 2-month honeymoon period or a break. I mean, I wouldn't call it as honeymoon, because when the customers have a lot of issues, it is not to kind of put a blind eye on that. There's a lot of issues that the people are facing in this pandemic situation, but just from the terminology, I think it is a EMI off or a holiday for a couple of months, right? So that will have its own effect in terms of the discipline. So in that way, the companies have to kind of model a constant communication system. It need not be just about reminding somebody to kind of pay back the EMI, but it could be even educating them about how to once keep themselves safe from COVID-19, or what are the safety measures and stuff like that. But these kind of soft communications have to keep happening. So that's what is probably we are all following it. Yeah.
Sure. Thanks, Madhu. This was good. And the next one is to our guest Ashish. Ashish, taking cue from what Madhu just said about moratorium and how the fintech community and ecosystem has responded to a moratorium in hand in a very innovative way. Really appreciate that. I think that is in a way engaging with the customers. How do you what do you have to say about this in terms of tech's way and then the fintech's way of answering the current issue and then solve the problem? And what's been your experience on this?
So I think thanks, Irfan. Good afternoon, everybody, and really appreciate having me on the call. If we see this is one of the unprecedented times, and I'm pretty sure unprecedented word has been listened by us 10 times in a day in every call, every webinar we attend. But it is true that this is something which is unprecedented and something which nobody thought around it. Good part about most of us which are in fintech, financial services, that for last 1.5 years, this was the fourth shock which we saw after some of the credit shocks which we saw in last 18 months. So we were to a large extent were prepared around our liquidities, our algorithms, most of the tech stacks were somehow tested for the shocks. Not to this extent, but it was tested for shocks. Having said that, in case this would have been the direct shock which would have come to the industry before the IL&FS crisis or the Yes Bank or the other crises would have come, the situation could have been very different. Having said that, when this crisis started unfolding, I think as any fintech or any businesses, there were 4 aspects to the businesses which one would need to take care. The first is the employees. The second is customers. Third is how does the business models will evolve. And the fourth is the algorithms and the technologies, how do they will work in the overall game. I think given the fact that most of us are tech driven and virtually can work from everywhere, this issue which fintechs have handled really well is that putting their employees' safety first, asking them to work from home, and that has worked wonderfully. The transition was as smooth as possible. Literally, there was no loss of time. There is no loss of customer queries. We were able to handle 10x of the queries which we normally receive in a month, which we have received because of the evolving situations related to COVID-19, which includes the RBI moratorium, which includes customers delaying payments, customers looking for ideas, etc. And which means that we need to put extra efforts to really ensure that we provide them the support in this kind of a period. And so the employees really able to move from office to home without having any hiccup, without having any confusions around what are their roles to be played. Second, on the customer side, we really think that the technology is played a big role, and it will become much larger as the time will pass. Today, our customers, we were able to communicate them with very clearly. The policies were very clear. Unlike many of the larger institutions, we were able to articulate very customer-centric policies because it was through the mobile phone, through the website, like Madhu has mentioned, and the reach to the customers became much easier. We were able to communicate the differences between various kind of issues which the moratorium has, like whether the interest will be paid or not. Their confusion could be resolved. Many of the customers came back and said that, oh, look, our understanding of moratorium was different, and they ultimately end up paying us that. And it created a huge amount of goodwill and huge amount of connect with the customers for all of us. Third thing is that as we look forward, the business models, how do we really see them going forward? The way I see that, like everybody else, the people automation technology will play a larger part. Given that we are already quite centric to a technology, we think that the fintechs will start playing a much bigger role into the ecosystem going forward. Many of us are unlevered balance sheets. We are just started to take debt from the lenders. We are quite equity funded, so which allows us to really take this crisis head on. And as the time will improve, which will improve, nobody knows when it will be, but whether it is 2 months, 4 months, but the things will come back. And that point in time, it will become much easier for us to really provide that kind of services to the customers and come back with much more innovative products, much more innovative ability to reach out to the customers. We should also expect that the quality of customers will go up across the board. The banks will start, everybody will tighten their underwriting standards, like we are doing it. Today we are quite choosy in whom to we lend. Sorry. Many of the existing customers also, we have cleaned up our portfolios to see that how do whether we should continue to lend to them in the current times, etc. And the underwriting standards for next few quarters will go up, and which means that everybody will start playing into the next league. And the fourth thing, which I think which will make a lot of difference from the product innovation and from a technology perspective, is the algorithms, which will undergo some changes. And as we build these algorithms, the understanding of the businesses are already built into it, and we think that this will continue to evolve over a period of time. The current economic conditions will lead us to reassess those algorithms for next 3, 4, 6 months, and this will allow us to really build the next layer of most sophisticated algorithms from a risk as well as from the customer acquisition perspective. That's it from my side, Irfan.
Sure. Thanks, Ashish. I think you actually laid the bridge to the next question in terms of how do we really manage the issue in hand, and also the P&L and balance sheet perspective, which is the liquidity that we need, the growth that we see, and also the cost management perspective from in terms of just education to managing the current staff and cost, etc. So Satyam, if you could take this and then share your perspective on how do you balance between liquidity, growth, and also cost management in this current context.
Yeah, sure, Irfan. So if we see from a cost point of view, then fintechs are no different. The added benefit with the fintech being is that Tech has been at the center of all the developments around which the whole organization has been built, and tech gives you a great advantage in terms of cost. So you are able to quickly realign because lots of cost is variable costs. So on a variable cost, you are able to go back to near zero or to the most efficient level, and on fixed cost also you are able to come down pretty quickly. So unlike multiple organizations, we do not go through the long challenge of vendor to vendor and all those discussions. So that cost part, and as Ashish was also mentioning earlier, for the lending ecosystem, it has not been very easy. Last 17-18 months has not been very easy since the time we saw the IL&FS crisis and the way it precipitated in the domestic ecosystem. And even if before the lockdown, we had a Yes Bank event happening. So cost-wise, most of the fintech has been pretty lean, and I would say not pretty lean, actually highly lean. Having said that, the other part also was happening from the balance sheet point of view is that most of the fintechs were under leveraged as the COVID-19 happened. So the leverage in most of the fintechs books will typically be anything between 0.5 to 2 times. So it's essentially lots of capital which has been raised has not been burned, it has been deployed, and which is deployed or kept in cash in accounts and the funds, and so that's something which gives a very long runway to the business, and also the nature of the business being pretty frequent rotation, and so that's one part as far as the cost and the organizational management or navigation is concerned. Having ensured that the organization sustains through a longer period of economic instability or instability, what we see at the same time is that the next phase of growth will come less from the balance sheet lending for the fintechs. I mean, of course, I mean RBI has recently, for the first time, they have recognized smaller NBFCs from the point of view that they have specifically provided a different TLTRO window for organizations less than 500 or less than 5,000 size in AUM. So that creates lots of strength in the ecosystem in the sense that the government as well as the institutions are trying to both recognize your contribution to the economy and the fact that they are creating a separate window for liquidity. Having said that, it will be less of a balance sheet business in the next 17-18 months. I think what technology companies or fintechs will be using more and more is the railroads that they have created in terms of the digital KYC, video KYC, algos for underwriting, and particularly underwriting remotely. So if you compare the fintechs with the traditional institutions have always been, the portfolio's strength has always been about touching the customer in person. And in last 4 years, the fintech community has demonstrated that there's just too much of the data points which is available both publicly as well as financially in Indian ecosystem, which you can look and underwrite, and you can showcase the portfolio performance. The portfolio is now tried and tested across multiple cycles over the last 3 to 4 years. And so naturally, I think if the institutions who will be coming with a wholesale lender will be coming to reach out with those government schemes or the intended schemes to the end consumer on the back of the railroad which has been created by the fintech. So the fintech will see lots of interplay between the partnerships from the wholesale lender to the fintech to the end customers, and many of the platforms by and large are commanded by fintech. So, and when we see of whether the e-com or whether we see even B2B sales or groceries, kirana, provision stores, lots of this B2B business are currently done through the fintech's algo chain. And it's easy for any wholesale lender to come and do a play over there if they want to ramp up, and which everyone wants to ramp up now. So we'll see lots of interplay. So the P&L growth will happen more on the partnership side and less on the balance sheet side. That's how we see.
Sure. Thanks, So my next one is to Madhu. Madhu, given the shorter tenure of the product, and which means, even if a dip in terms of disbursement coming down, the percentage cost shoots up. So how do you see this and the impact of that on P&L? AUMs, very quickly it's like a treadmill. You'll have to be on the treadmill. Anything dipping, disbursement dipping will have impact. So how do you see this? How do you see the nature of cost and shorter tenure product interplay?
Yeah, I think so. First thing, I think with respect to shorter tenure products, the fintech companies which are running those shorter tenure products, I think they are on a fairer side of the ALM, because these fintechs would be borrowing for about like 12 months or 24 months from the banks or even from Vivritis of the world, but their entire book would be anywhere between like 3 months to 6 months. In that case, they are very much on the fairer side of the ALM. So therefore, the liquidity would not be a major problem for the fintechs. That's why you would not find too many fintechs having a lot of hues and cries about banks not providing moratorium to the fintechs, whoever is running kind of a shorter tenure product, right? So that's point number one. Point number two, if you just look at the entire cost structure of the fintechs, right? So one of the primary cost goes into marketing. The second cost goes into data, as in like all your Sybils of the world and all the third-party APIs what we use. I think that's where the second major cost actually goes in. So while we are not, most of us are not doing any kind of a disbursement at this stage, the cost has almost come to nil to nothing, only about the fixed cost, which is about employee salary, and unlike other traditional lenders, we don't have this brick and mortar kind of a shops. More or less, we have a centralized offices in one of these metros. So in that way, the cost really drills down a lot to only about the employee salary and the rentals. But there is I cannot imagine any other cost which can be involved in. So in that way, the profitability is going to reduce because we are not disbursing, but accordingly the cost is also drastically going to reduce. So there will be kind of a marginal profits can still be expected for the months of March and April, but business has to definitely restart. Now, quickly, just taking a word on the business restart, I think it's more to do with so the entire lockdown strategy and how it eases in India, because we have to be lookout for what is the strategy that will come out in India in terms of which pin codes or which kind of sectors which are kind of opening up, and in the similar way, I think we have to model our entire products to open up to such pin codes or such segments of industries, and definitely ramp up the business as well. So that's primarily my view on the entire short tenure product fintechs, Irfan. Yeah.
Sure. I think one last question to the speakers here, Ashish, if you can take this. What are the learnings from globally coming in, especially the adjacent China market, which has seen the COVID curve, and then there is a lot of significant fintech play, and you can add some other geographies also, and also the expectations around equity market around. So your thoughts there.
Sure. So I think it is still very early. Like I keep saying to my team that it is a highly unknown market. If anybody knows about if anybody claims that he knows about what will happen, I think he doesn't know what's happening. So I'll just take few things on what I am seeing and when we speak to our friends out in global markets, what they are seeing it. One thing from China which is coming in, that the delinquencies across their portfolios, what went up in the initial phases, which we are seeing currently the same kind of delinquencies which we are observing in Italy, what we are observing in India. So which says that it's globally a similar kind of a human behavior or the business behavior which we are witnessing, at least in the initial phases. Then we go and when we check with them how they are seeing today, many of the businesses are recovering, which is one of the inventory restocking. The people are coming back into the markets. doing some kind of buying, etc. Few of the segments are badly hit, which are known to everybody, like tourism, aviation, the discretionary spends, which will take a lot of time to come in. And like everybody, most of the players has stopped funding to those segments. I think this kind of differentiated factors towards the sector will continue for some more time for next at least 12 to 18 months before many of these segments find their foots again. And what we are seeing also on the globally from the liquidity perspective, that there is a huge amount of liquidity getting pumped into the system. The good part about today's liquidity coming into the system versus what happened in 2008 is that today's the liquidity is more focused by the regulator and by the central banks towards small businesses, towards the people who are financing small businesses, unlike the larger banks. So there is a program by Federal Reserve, there is a program by RBI towards TLTROs for the smaller NBFCs. There are talks of providing assistance to the MSME segments, etc. And I think which is a very welcome thing, that it is a right way to really address the stresses which has happened in people's life. And so globally, people are learning from each other, so it becomes very critical for us and everybody to just keep looking at it, what Italy is doing, what China is doing, what India is doing, and you can expect many of these learnings will be picked up by the other countries. Many will pick up what India is doing. India has done exceptionally well in the way they have controlled the curve till now. Similarly, what China and US has done for picking up the slack in the economy could be a learning for us. And we can see this kind of a global coordination to continue for some more time. And so these are the few things which we are seeing globally into the spaces. One more thing which I would like to add, that in this entire game of the current stress which is happening across the world in the financial sectors, and I will talk specifically for the financial sector, few of the segment and the industries which will come very strongly are the ones who are very adaptive towards the technology, who are very adaptive towards building the new products, who are able to manage their liquidity well for next 6 to 12 months, are the ones who will come out as a winners. And at this point in time, like everybody else, the core focus is to see that how does after 31st May the collections move up when the customers come back into the market. And those are the things which everybody is watching. My personal view is that once the things normalizes, many of the things what we were seeing, let's say 6 months back, the things will go back to those algorithms. Those things will come back into the picture with a little bit modification. That's from my side. Irfan, any questions? More than happy.
Thanks, Ashish. Anita?
Thank you. If you would like to ask a question, please signal by pressing star 1 on your telephone keypad. If you are using a speakerphone, please make sure your mute function is turned off to allow your signal to reach our equipment. A voice prompt on the phone line will indicate when your line is open. Please state your name before posing your question. Again, that's star 1 to ask a question. And we'll pause for just a moment to allow everyone an opportunity to signal for questions. And now we take our first question. Caller, your line is open. Please go ahead.
Hi, my question is with regards to these, fintech NBFCs which have two kinds of portfolios. So one is a consumer loan, which is, end use is not defined, but it's for discretionary purposes. And depending on how these customers respond, you actually start giving them, personal loans. So while initially your book may be like a 80-20, and later on, personal loans start becoming more as and when you know the borrower profile well, you know the cluster well, and then you have a cluster-based approach, right? So in the current crisis, what happens to those personal loans, because that is where the risk is higher. Consumer durables is still lower ticket, higher turnaround, but those personal loans which are given for 1-2 years, what's the impact on those? And again, I mean, there are quite a few NBFCs in this area, but I don't want to name them. So what's your take on that?
Sure. Shall I take this? I think this all at the end of the day plays out as a risk management. If you look at it, many of the banks, when they acquire customers for their liability side first. They offer them savings account. After they learn their behavior, they start offering them the products on the asset side. Similarly, if you try to visualize the customers who comes to any of these fintechs, whom they give first the very short-term loan, which could be a purchase financing loan, which could be a short-term loan, and over a period of time, there is a behavior pattern which established over a period of time, which includes how much he makes the money, how he's paying the money, whether he's paying on time, etc., which becomes a behavior about the customers, and the same behavior along with a risk matrices. So so it is not that anybody who is paying on time for 6 months on the 6 months loan will be eligible to get a 2-year money. There will be on the top, there will be a lot of credit underwriting which will be done to ensure that they fit into a 2-year horizon kind of a stress test, and based on that the 2-year money is given to those customers. So it is a blend of two products where the customer is kept at the center. Especially it is quite unfortunate in India that if you want a home loan, you go to home loan department. If you want a credit card, you need to go to credit card department. And both the places you need to do your KYC again, you need to prove yourself again and again. Whereas when we look at the customer as a center, it becomes very critical. If he is eligible for 2-year money after seeing his behavior, the fintechs are today able to really provide a differentiated treatment and differentiated experience to each customer on an individual level, and which really build their risk management as well as ability to really monetize on the customers in a right way.
Yeah, so this is Madhu here, just adding on to very quickly adding on to Ashish's point. I think it goes very case by case as well, so we need to communicate to the customer to understand his exact situation. Right, so there is varied situations what comes from a personal loan customer, starting from whether it is a job loss or starting from whether it is a salary deduction or whether it is something like he has to migrate to some other place or so, right? So it depends on different class of customers, and the solutions in terms of what we have to understand those customers and offer the solutions also should be innovative. Be kind of even extending the moratorium to ease the EMIs to, there are a bunch of solutions what one has to provide to a different cluster of those kind of customers. Yeah.
Got it. Thanks. And secondly, if you just look at the profiles of your respective companies, Early Salary, Loan Tap, Crazy Bee, again, the ALMs are very different, right? So for somebody like a Crazy Bee, it's still like a positive ALM. Loan Tap, I think the loans, my knowledge is the loans are slightly longer tenure. So would this crisis, you will be able to differentiate between companies which give longer term money, but in the market they raise money for, let's say, 12-18 months, but the loans may be like a 2 years. So those experiencing with negative ALM are the ones which will be deeply impacted. Any differentiation between within the fintech. So as an investor, if at all we have to look at the space, which one should we look at? Of course, positive ALM makes sense. But again, some of these companies, like, LoanTap is very well funded, right? So from an equity perspective. So how do you look at the space then?
Yeah, so Satyam here from LoanTap. As I said, none of the companies go overboard as far as the ALM management is concerned. So it's also a question of how well you manage your ALM. So whether it's 18 month or 20 month, and whether it's an equity, you also have a leverage on the portfolio sale. You are able to sell your portfolio because you have a slightly longer duration of the portfolio, which banks or the larger institutions are willing to buy. So you'll have to look at a balance sheet. I don't think, and of course, one of the things which has to be, I think, which stands out in most of this situation is the segment strength. So the segment to which it's lending, because ultimately it's money which is going out and the money has to come back. So if the segment strength is strong, management is strong, and the fact that ALM is not skewed, okay, I think the answer lies there. And of course, how much equity is there? So it's a combination of equity, segment strength, balance sheet, ALM, and the management strength. So who has seen how management has seen cycles and also. So I think it's a combination, and it also depends on the investment strategy of the fund. So there is no answer how to look at it, but that's how I would say.
Got it. And my last question would be, in these times, what do you expect deal multiples to be like? I mean, especially on the equity front. So it's not that the taps will be off. You will still see some investors coming and investing. So compared to the past multiples now, I mean, where you see the curve heading?
So, if I have to take that question, Irfan, then we do not see a difference in terms of the multiples, because unlike a global ecosystem, I think the fintech ecosystem has been relatively sane in India. It has not been insane in terms of the valuation multiples. So having said that, but at the same time, the nature of transactions which will emerge is also, some of them will be from the global interest, strategic interest in India, and some of them will also be from the domestic strategic interest also, which is also, you'll have to see how susceptible they are in their own portfolio. So if there is some strategic player who knows that they did a fintech play badly, then those multiples, I think, will be in a different range. So do I see a multiple changing dramatically in the fintech ecosystem? I don't see it, because I think most of the fintechs has been in a very narrow band. I mean, Irfan or Ashish, probably you can comment on it, because I have seen it operating in a very narrow band.
No, I guess that's right, Satyam. This is Madhu here. I guess the valuations for the fintech is kind of quite sane in India. I think we have been on a very much the multiples what has given to any fintech in the fundraise, even in the very recent past, has been in line with what a typical personal loan company in India would have. And of course, the traditional companies like Bajaj have probably got the highest multiples, but I don't think the fintechs have enjoyed such high multiples. So in that way, the PE multiples were never been bloated as such for the fintech industry itself. So I don't see that post this. Of course, there is a specific settlement period, call it a 3-month period or a 6-month period. But beyond that, I don't see that the multiples should get corrected largely. Yeah.
Also, just to add to both of them, I think it will also be a question. The next question.
Thank you. And now we open our line to our next participant. Your line is open. Please introduce yourself, your name and your company, and please one question aloud, if you don't mind. Thank you.
Sure. Hi, this is Roshan Chutke from ICICI Prudential AMC. Am I audible?
Yes, please go ahead.
Hello? Yeah, thanks so much.
Please go ahead.
I just wanted to understand this I'm presuming many of the fintechs must have offered this opt-out facility to their borrowers in this moratorium phase. Sorry, I joined the con call a little later.
I'm afraid that participants disconnected.
No problem. Let's take the next one, Anita.
We have no
As
further
we have
questions at this time, sir. Boss, as a reminder, please press *1 to ask a question. We have a participant in the queue. Would you like to take that question, sir?
Yes, please.
Caller, your line is open. Please go ahead. Please state your name and your company before posing your question. Thank you.
Hi, I'm Naman. I'm ex-Vivriti Capital. Am I audible?
Yes, you are.
Yes, Naman.
Okay, thank you. Yeah, so I wanted to ask you, sir, so anyone can answer this question. So basically what I've seen in the fintech lending side is the company's valuation are usually driven by the technology, as the investors feel that the path to profitability would be driven by reducing the CAC, and technology is the key to that. But however, I feel that given the pandemic crisis now, a lot of money would be spent on feet on street collection models. So do you think that would affect the valuation of these companies, as there would be a lot of cash burn on collections, and this is something which cannot be driven through technology? Thank you.
Yeah, Naman, this is Madhu here. I think Ashish and so I'll try to take kind of answer this. So first thing is, Naman, I think based on technology, somewhere somebody getting funded is only during the seed rounds or on the very early rounds of funding. So that is primarily it was the timelines when we were just starting up, or we were in the early stages of just creating the books and stuff like that. But on a certain size of a fintech, or when we start building up a specific balance sheet, I think we are largely evaluated based on the asset quality. We are largely evaluated based on the profitability. A lot of us are either on a PAT level profitable, or we are at a PBT level. We are at a operational level profitable. I don't think we are given such a creamy way of getting evaluated just based on some tech product or the kind of customers what we have or the customer we have evaluated. I think that particular evaluation is quite different between the size of the company. So that is point number one, right? So point number two is, so the fintechs as such had different models. Different fintechs have different models in terms of people were focused on the digital collection methodology. The people had a lot of collection folks. For example, a company like ours, directly, indirectly, we have about like 1,500 folks on collections, right? So only the companies which had some of the basics right, I think we are the ones who are able to grow in the industry, right? So be it the early salary, be it the loan tap, I think some of the basics or the fundamentals of lending and collections were very much in place, and that's one of the reasons why not just the equity investors, but we day in and day out deal with a lot of debt investors as well. So the evaluation happens on a multifold and on a regular pace. In such things, I think it's pretty strong that some of the guys who are able to collect it have already done enough of collections during this period, and then they are in a much better position to kind of save their balance sheets and as well as look for correcting their P&L in very short time. So if you guys have to add, Satyam or Ashish, you can add to this, please.
Yeah, I think absolutely. Most of us are profitable or just turning profitable before this crisis started. So we never burned the money in that sense. And second, the valuation is not only the game of AUMs or the game of P&L. It is also about which sector you are in. Like in the same segment, you will have different NBFCs who are trading from anywhere between 2 to 8 times price to book. So management quality, the kind of book, the kind of visibility the people have. So it's a quite a complex than just trying to say that the fintechs there would be a few fintechs who will get different valuations than the others, but this is all based on what they see and what kind of path and the sustainability they show over a period of time. So many of those keep factoring in the kind of growth which we have shown over the last few years.
Yeah, if one can move to the next question, I think it has been addressed comprehensively.
Yeah. So this will be the last question, and then whichever are the questions posted on the dashboard, we'll get back to you separately offline, writing back to you. So Anita, we can take the last question for the day.
Thank you, sir. And ladies and gentlemen, if you would like to ask a question from our presenters today, please you can ask a question via the web interface. Simply type your question in the Q&A box and click send. And now we take our last question. Caller, your line is open. Please go ahead. Please state your name and your company before posing your question.
Yeah, thanks for taking my question. This is Roshan again from ICICI Prudential AMC. I just wanted to understand this. I'm presuming that you are on an opt-out basis as far as your borrowers are concerned. Now, do you worry that there can be a moral hazard of sorts playing out post this May 31st deadline of when the moratorium ends, what kind of borrower behavior do you envisage? I'm sorry if this question has been covered earlier, but if you can just help me with this question.
Yeah, Irfan, let me take it. This is Satyam from Loan Tap Roshan. So, in a current situation, as everyone is saying, it's very difficult business to be in a prediction business. Okay. However, please understand, all the customers that we are dealing here are small individuals, okay, who are salaried, and by the nature of the employment or by the nature of the digital awareness or being a digital native, we see more and more customers coming from an IT, ITS, banking, financial services, overall services background. And at the same time, we do not see too much of the customers. So far, we have not seen a very significant segment coming from hotel, aviations and all, because there again, you have lots of informal employment also. Okay. So the employment size-wise, IT, ITS is the biggest employer in India, and then comes BFSI. Naturally, each of our portfolio represents a similar cycle. So unless until we are expecting large MNCs in IT, ITS sector to drive down the deep job losses, we are not expecting a significant portfolio performance changes. So that's in nutshell. Each of us must be having anything between 10 to 15% portfolio from manufacturing, aviations, and informal segment all put together. Okay. There again, depending upon what kind of stimulus government comes or doesn't come, there will be some collection level re-engagements, but that collection level re-engagement, unlike what we are imagining or some of the questions I see, will not be physical re-engagement. Those re-engagement will also be a digital and a call center led re-engagements. Okay. So you cannot. We will be naive in assuming that it will lead to a cost escalation all of a sudden. Okay. Because all our customers have been on a tech backend, they are available, and it's the collection is more about being in touch with customer, tracing, and being in touch for collection. It is not about physically intimidating a customer. So you can't intimidate someone and collect. Those days are gone. Okay. So portfolio wise, do we see a different degree of a challenge post June? There will be a temporary spike in those collection mechanism or the NPA recognition, but the collection efficiency on the NPA cases also will look to you more like, if the current collection efficiency is anything between 40 to 50% on NPA cases, that will increase to 70 to 90%. And I think there is enough model both globally as well as certain companies are also having in domestically on the asset management side, which is proving the same kind of a number.
Okay. Sir, just
I
to
hope
understand,
it addresses.
are you all offering? Yeah, thanks so much.
Pardon?
Are you all offering opt-out facility to your customers?
No, Roshan. So it's RBI as well as FAQ. Just let me just complete it. It's very clear whether customer is opting out or opting in. Okay, you have to give a moratorium. So the only difference is that unlike a bank, I do not come and say that if you are doing this, then only you will get a moratorium. I touch base with a customer. Even if a customer reaches me on a WhatsApp, on a LinkedIn, so we have a multiple channels, so omni-channel approach to customer service. Any channel from where this kind of a request comes in, we do it. And as a matter of fact, each of us has gone back to every customers of ours just to check what they are asking for. Even if people have not opted for a moratorium in April, they might opt for a moratorium if there is a change in their own organization's job position in the next couple of days, because the organizations are still grappling with their response to the pandemic. So it's a continuous process.
Okay.
Yeah.
Thank you.
Broadly, when you offered
Anita.
sorry, if I can just squeeze in one last question.
My apologies.
Broadly,
we are out of time for phone questions. My apologies. Mr. Irfan, I'd like to turn the call back to you for any additional or closing remarks.
Roshan, I'll get back to you anyway. We have your credentials and we'll write to you, and then we can touch base to ensure that your queries are completely addressed. Thanks everyone. I'd like to thank Satyam, Madhu, and Ashish for taking out time and agreeing to join us and talk to our participants. So, as concluding remarks, I think the success of fintech space is in identifying the practical ground level challenges and also finding technology driven solutions that are long term sustainable and scalable. The segment has already showed its nimbleness by coming up with tech driven solutions to constantly communicate with customers, engage with other stakeholders in a cost effective manner, of course. They have been the quickest to think about EMI structures that could be consumer friendly, and of course, cost consciousness is in the DNA of this crop of fintech. The positive is that there is demand, correct demand that exists for growth, and calibrated growth is the need of the hour. And fintech consumer finance is best place to drive this for the NBFCs. With this, I thank everyone again. Good evening. Stay safe.
Thank you very much. Thank you.
Thank you. Thank you.